Let's do it, folks. Good morning, one and all. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 24th of January. I'm your host, JD Durkin. We do begin this morning's show with a bit of developing news here from the floor of the NYSE. An unexpected exchange-related issue resulted in dozens of halted stocks earlier this morning here on the floor of the New York Stock Exchange in a scene that one person told me in a remark, quote, "It's a huge problem. I've never seen anything like it." Names including McDonald's, Verizon, even Morgan Stanley, all impacted, according to the NYSE. And while it is still very much unclear what exactly happened, a single price for each stock is determined at the open or the opening print, and orders to buy and sell are contingent on that established number. So there is a bit of a question about the opening price and what it actually was for a lot of these names. There is a limit up, a limit down of 10%. It's essentially a protection of sorts against unexpected volatility. And it was clear within really just a moment or two of the opening bell, sharply at 9:30 a.m. earlier today, that this was clearly no ordinary trading session. Traders flashing their computer screens and tablets left and right, usually awash with tons of orders, nearly blank in many cases, or names like AT&T, which will usually pop with more than 200,000 orders at the open, showing only 200 orders. One longtime vet tells me, quote, "It's a screw up." We have no official statement yet from the New York Stock Exchange, but we'll bring you the latest as soon as we learn more. Let's turn our attention now for what is on tap for this morning's broadcast. We will talk earnings as Wall Street digests a flurry of corporate reports released before the bell, and we'll give you a bit of a preview for what's after the bell, too. Plus, we'll tell you what's going on with Amazon as the tech giant launches a new prescription subscription service. See, they phrase it that way intentionally to tie me up. And finally, we tell you why Google is subject of yet another, DOJ lawsuit. For more on those stories and so much more, we now welcome in Art Hogan. Look at this. Love having him. Art is Managing Director and Chief Market Strategist at B. Riley Financial. Art, good morning.
Good morning, JD. Thanks so much for having me.
Absolutely. As you can see, it's just another calm day here on the NYSE. Nothing unusual to report. Of course, that's not the case. But so I'm actually going to take a check of the big board because I don't know where we've been trading at. All right, stocks are down. The S&P is just above that 4,000 level. Although we have been on back-to-back sessions in the green, Art, what market moves and movers are you most closely following on this Tuesday morning? What do you think is driving some of the sentiment out there?
Yeah, I would tell you this. We got some economic data that came in a bit better than expected this morning in some of the ISM PMIs. And I think that's, consistent with what we've seen in terms of the economic data stream, which has had more good news than bad news. And I think in large part, the earnings picture is just starting to roll out in earnest this week. We'll get Microsoft, which is very important to us in terms of how legacy technology is doing, how much their spend on Chat GPT lines up with what their revenues look like and what their guidance is for 2023. We'll also get all the credit card companies reporting this week, which gives us a real good read on how the consumer's faring and what that looks like heading into the new year. So really busy week, and in large part what we've had is a more positive than expected January, especially for technology stocks. And today's the first significant pullback we've seen over the course of the last 3 weeks.
Have you been surprised that January has been off to as hot a start as it has been here, Art?
Yeah, good question. I think it's, what's interesting is that there's a term that's used loosely called the January effect, which after you get tax loss selling and investors see what's been the most beaten up, you get sort of this worst first impact in the first 3 weeks of January. So you get the most beaten down sectors that get some sponsorship. We've clearly seen that, and typically what happens is the winners get sold as sort of a ATM for that sponsorship of the beaten up names. So you've seen things like materials and energy not fare as well in January, whereas they were the best performing sectors in the S&P 500 last year. What's really caught in a bit is technology, communication services, consumer discretionary. And it's hard to know if that sort of excitement and enthusiasm in the first couple of weeks of January can kind of work its way through the actual facts when we get earnings reported. And, will the kind of the run that we've seen be justified by what these companies have to say about how they did in the fourth quarter and how they suspect they'll be doing in 2023?
Absolutely. Of course, we have lots of cross currents on the markets. We've got the Fed, which is a day-by-day storyline. We are in the heart of earnings season. We also have many of 2022's questions from abroad in the form of China, the Russian war in Ukraine, right? The largest land war in Europe since 1945. All these things have carried over into 2023. Art, what are some of the biggest factors pushing things one way or another, you think, if they're not any of the four or so that I just tried to lay out?
Yeah, I think all four are really important, and I think half of those have actually kind of hit a crescendo and are getting better, right? So first and foremost, China, the biggest concern was the reopening there. Looks like we're getting that in earnest. We talked about that, over the course of the summertime. Finally, is happening. I think that's going to spur some demand for goods and services globally. That's a real positive and a tailwind. The Fed clearly has been a headwind since the beginning of last year, but clearly the choreographed message from all the Fed speakers we've heard over the last couple of weeks really is singing a tune of we're going to slow down and eventually get to our terminal rate, and that likely happens in March, and then we're going to pause. I think a pause by this Fed would again, ignite some risk-on appetite in the market. Now, the war in Ukraine is something we expected to last for a month, and now we're working on our 13th month of that. So clearly that has surprised everybody. The news is very dynamic there, but I suspect that if we were able to find Russia exiting this incursion, this war, at some point in time in 23, which we hoped would happen in 2022, that would clearly be a positive, but that's certainly not on the short-term horizon. So when you add things up, I think we enter 23 in a better fashion than we entered 22, with a lot of the headwinds or multiple, many of the headwinds that we faced heading into 2022 starting to dissipate. China and the Fed seem to be two of the largest. And at the very same time, we seem to have hit peak inflation. Certainly, still sit in a place with peak pessimism, with positioning by hedge fund managers still extremely short, and then working our way through earnings season to find out if the valuations that we've placed on corporate America are justified or overdone.
Yeah, absolutely. With regards to economic data here, Art, that we're following, because we love economic data, right? We love pouring over this stuff day by day. Come on, we know how it works by now. We are looking ahead here to last year's Q4 GDP reading. It's set out on Thursday of this week, if I'm not mistaken. If the U.S. economy expanded in that quarter, what would this tell you about the state of things, if anything, given that it is sort of data from the rear view after all?
Yeah, unfortunately, we've got a Federal Reserve that kind of works with data in the rearview mirror, whether it's the economic data pertaining to inflation, which clearly is lagging, whether it's economic data, as it pertains to GDP growth, and clearly that's got a lag to it. We're talking about things that happened months ago, and unfortunately, the employment data also is looking in the rearview mirror. But what we did get yesterday was a look at the leading economic indicators, and that has been flashing a recession warning for 3 straight months, and is sitting at a place where that's showing some concern. So we really have to kind of juxtapose the data that we know the Fed is looking at and using to chart their path of monetary policy, and what we've seen about economic data. The December retail sales were a bit slower than we like. Leading economic indicators were disappointing yesterday. And layer that against things that we know, CPI coming in hard, PCE likely to be reported lower, and both those heading in the right direction. And then the real conundrum for the Fed is, why is the labor market so resilient? Why are the weekly jobless claims, so yet to crack that 225, 250 range, and the like, especially in the wake of all of the layoffs we've heard about?
Yeah, and like, where are the workers, right, for all these open jobs? I know there might be some concerns with regards to potentially skewed JOLTS data, but it still opens up this question of what is going on with this, with the job market as hot as it remains? You mentioned their PCE. We're looking forward to that later on this week. So my reading of it was that you expect it to be indicative of inflation continuing to cool. Is that what you're hoping for
Yeah,
and
as a matter of
expecting
fact, if you
for
were
at
to
a PCE this week?
Yeah, I think if you look at the PCE, which is the Fed's preferred measure of inflation, we all look at the CPI and sort of extrapolate that out to the PCE. If you look at the CPI, the core CPI, which recently reported and surprisingly cooler than expected, you can extrapolate that out to what the PCE looks like in the here and now, but you can certainly sort of look at the trend that we've seen and take the things that we know, for example, the housing prices and how much they've come down versus the government measures, which uses owner's equivalent rent, and then try to track where we would be if we used real live data. If we used, for example, Zillow data, instead of owner's equivalent rent like the government does, and say, where would the PCE and CPI be right now, and what do we expect that looks like by the end of the year? And in both measures, we're significantly lower in real-time inflation, and expect by the fourth quarter that we'll have a PCE, a core PCE that's at or about 3%, within shouting distance of the Fed's target, a CPI that's going to be between 3.5% and 4%, nearly half of where we started at, coming from the peak. And I think that directionally, if that's the case, by the time the fourth quarter rolls around, the Fed's going to look at their 5.25 or 5% terminal rate and say, we're too restrictive at this juncture. We likely need to sort of take our foot off the brake a little bit and perhaps factor in a couple of rate cuts in the fourth quarter. That's consensus right now. I certainly think directionally the inflation numbers are working in the favor of the Fed, saying, hey, we've done enough. We're seeing significant improvement. And I think that's why consensus has us backing off that terminal rate a bit in the fourth quarter.
Are the markets and the Fed on as different pages, as on pages that are as far apart as many people say that they are?
100%. Yeah. So yeah, I think that when you think about the good news is the Fed clearly has gotten to a place rapidly, right? They started too late, so they got to the restrictive level rapidly. And likely they're getting to the end of this cycle, meaning they're going to stop raising rates. What that does is it allows economic data to be looked at in an intuitive fashion. When we're in the middle of a rate hiking cycle, everything's sort of looked at through the lens of what does this mean to the Fed? Does that make them more aggressive? Does that keep them tighter for longer? When they pause, that gives us an opportunity to look at data and say, okay, this is good news, and good news is good news, right? And the market doesn't have to have that counterintuitive reaction to news. The second thing that it does is it allows us to understand that the Fed has reached that level of restrictiveness, and we can interpret inflation data and say, okay, at some juncture, they're likely to see this as being too much and not wanting to linger too long and slamming the economy into a recession. So I would say where the street and the Fed are lined up is that there's nearly 100% assumption that they're going to raise by 25 basis points. The street is in the same place as the Fed, and we've heard a whole parade of Fed speakers talk about that. Where the street differs from where the Fed is the street thinks they're underestimating how much inflation's coming down and overestimating the strength of the labor market. And therefore, the street has a couple of rate cuts at the end of this year. I think that's more likely to what ends up being in reality. I just don't think the Fed wants to talk that easy game just yet, because what they say probably has as much impact on the markets as what they do.
Of course, I do want to pivot here and ask you about earnings, but we're having such a good conversation on general macroeconomic conditions and the overall environment. Is there anything else there that's top of mind for you that you would want to underscore for our viewers before we get into some of the more specifics of the big names reporting this week? It's a busy week.
Yeah, I would tell you this. Well, one of the things I think that you get the sense is frustrating the Federal Reserve about their aggressive monetary policy is that typically when you have tight monetary policy and you're raising rates, you tend to see credit conditions tighten. And they did in the beginning part of this when we started moving, up 50 basis points and then 3 sequential 75 basis point increases. Some pretty significant moves and credit conditions tightened. Over the course of the last 2 months, credit conditions have eased. And that's frustrating to the Fed because one of the effects, one of the things that monetary policy is supposed to manifest when we're in this cycle is tighter credit conditions and higher unemployment. And two of the things that are on their sort of playbook just haven't come to fruition. The labor market remains robust and credit conditions are easing a bit. So sitting around the table, the Fed must be getting a sense of frustration. It's like, do we need to talk tough? Do we need to talk about being higher for longer? Do we need to sort of push out any notion of cutting rates anytime in 23? And I think that's happening. But I do think that there's a lag effect in both of those things. I think we'll start to feel these layoffs work their way into jobless claims. We'll start to see hiring intentions come down such that the JOLTS numbers will start to recede a bit. And I think by the end of the fourth quarter, we'll be less concerned that this strong labor market is causing undue concerns. But I think that the credit conditions, the tightening of that likely needs to get back to levels we were at, call it in July and August. And I think the Fed will sit back and say, okay, our job is starting to get closer to the end. We're likely restrictive enough, and hopefully we can orchestrate that ephemeral, softish landing.
Soft-ish landing. I like that for sure, because that's like, right? Not too hot, not too cold. It's kind of there in the middle. I appreciate the description. And I appreciate the context. Let's talk earnings here. J&J, 3M, GE, Verizon, all reporting before the bell this morning. Are any major takeaways from any of those names or any others that you're following that perhaps I did not mention?
Yeah, GE really a story of restructuring. They're spinning out divisions, so it's hard to look at the here and now and say, okay, this is what this is going to look like 6 or 12 months from now. So I think that in the middle of a transition, when we know that they have plans to spin off divisions, we look less at what they're talking about in terms of how last quarter looks. But I think their report was fine. 3M is one of the classic cases of sort of catching up to their growth and how much they spent. And whereas revenues beat expectations, their earnings did not, and that's really a story about margins, right? So they're sort of catching up. They were sort of fell into that quasi pandemic darling. A lot of the things that they make, we needed a lot of in 2020 and 2021, that we don't need as many of those things, and they need to work down that inventory level, and that's depressing margins. So I think Johnson & Johnson, the third company you talked about, clearly was one of the companies that had that sort of better than expected earnings and a modest beat on revenue. So they kind of checked both those boxes, and they kept their guidance the same. And that's probably the most important box to talk about. So when we look at this earnings reporting season, there's three boxes to check. The last is the most important. Did you beat on earnings versus consensus? Did you beat on revenues? And what did your guidance look like? And if you're not able to check all three of those boxes at this juncture, at the places we are, the reaction function to any of those misses is going to be a whole lot better than if you beat all three of those things.
Absolutely. We talked a bit about Microsoft earlier today, the Chat GPT / Open AI component. It's not the first investment Microsoft has made into Open AI, but it is the largest to the tune of at least multi-billion dollars, according to those reports that were confirmed. It's obviously the big name we're following at the close today. To touch back on that a bit more closely, what are some of the other biggest points you will be watching for in Microsoft's earnings report? It's always a very dense report with a lot of information to go through and a lot of things that I'm sure we'll all be talking about tomorrow morning.
Yeah, so it's interesting. So Microsoft already went through a couple of rounds of layoffs, which is interesting because the numbers sound so large until you put them in a percentage of their overall employment. And what's even more important to me to sort of elucidate is that it's not just that they call it 6% of their workforce that they're laying off. If you look at how much they hired in 20 and 21, they're really just getting back to where they were in terms of total employment from the middle of 21. So I think that the right sizing of the labor force is important. I certainly think that um, what they're doing in terms of selling into the global market is going to be important too. So the non-U.S. sales, I think that's picked up. We got some pretty good information on the European economy that came out this morning. So perhaps the fear of that European recession doesn't adversely affect them. Microsoft sits in a place where their free cash flow is very defensible, and it's trading at a multiple that's very defensible. So obviously what's been interesting over the course of the last 2 weeks is their announcement of layoffs, and certainly the $10 billion or thereabouts that they're putting into artificial intelligence vis-a-vis ChatGPT. But I think what's really important is, okay, how did we do against consensus? The year-over-year comps are very difficult, and were they able to beat consensus estimates and earnings? And what's guidance going to look like? And how is Wall Street going to react to the kind of money that they're spending? $10 billion sounds like a lot of money until you see what the war chest of capital in cash that Microsoft has. Should be a very interesting conference call, and I'd love to listen in on some of the questions about what the potential viability is for artificial intelligence and how they're going to monetize this investment.
Do you like listening into earnings calls? And if so, I can't help but wonder, warning, this is going to be the most important question I ask you. Do you have a go-to snack while you're listening to earnings calls? Because it's late in the day, that's like, for me, that's my snack window. You know what I'm saying? So I'll reach for Oreos or something to keep me energized as I listen through.
Right. Yeah. I think that what you can't do is you can't play this game that when an analyst finally gets asked this question, he says, "Great quarter, guys," right? Because if you played that drinking game, that you'd never make it to the end of the call. But what I will tell you, that the best thing to sort of work on is something that doesn't make a whole lot of noise, so it doesn't interrupt. So chips and salsa are sort of out. I think something more like a cracker and a hummus is probably your best bet at conference call time.
Yeah, well said. That's right. Yeah, you got to be conscious, especially with the microphones muted, unmuted. It's I always call it earnings palooza for a reason. So I do appreciate that context, and we will be listening very closely to Microsoft. Let's do a little look ahead to Tesla. Tesla's tomorrow? Did I get that right? Is Tesla tomorrow?
Yeah.
Or Tesla's later this week?
Tomorrow.
Yeah, it is.
Yeah.
There we go. The company recently shared delivery figures that missed expectations. You expect to see a bit of a similar story play itself out in earnings this time along for the EV giant.
Yeah, well, I think there's a reason that Tesla just recently announced their price cuts. for the most popular vehicles. Now, the Tesla bulls will talk about, okay, how much did the total vehicles grow year over year, and not talk about what expectations were. So the push and pull of any Tesla earnings report is always, hey, look at how much massive growth there is. I think what they'll try to lean into is this China reopening story is very important to them because it's a very large market for them. So I think that will be the good news that we are likely delivered in the conference call. I think that the price cuts happen for a reason. They're finally catching up to the production quotas. They're likely wanting to move more inventory out of there. So it's going to be one of the most difficult conference calls to sort of listen to, because it's very binary, right? There are the investors that just love this, and there are investors that have never liked it whatsoever, and they're getting some real competition from the incumbent OEMs. So I think it's going to be a mixed bag, but it's never boring.
Tesla stock, of course, has famously plummeted over the course of the last year. Is it a correction? Is it just is this, are people just, was this bound to happen? Is this Twitter induced? What is the Twitter component about this, if anything?
Yeah, all of the above, I think. When you think about Tesla, there's all sorts of things to think about, right? So I think the first and foremost, and probably the most important, is, they're still number one in EVs, but there's more competition, right? So just about every credible automotive OEM has an electronic vehicle offering, and they're producing more of them. So while they're still number one, there's a lot of people right behind them and paying a lot of money and working hard to catch up. That's probably the most important fundamental piece. Now, on a sort of more of a esoteric piece, how much attention is being taken away from the running of Tesla by Elon Musk while it works on sort of right sizing and making Twitter a better place for the world, or whatever he's doing. So I think that's part of the puzzle, which is it's hard to sort of really put a number around that. It's much more sort of ephemeral, esoteric. It's one of those things where you say to yourself, are investors concerned about this sort of lack of attention from a guy that was, before Twitter, running 4 other companies at the very same time? Hard to know, but it's certainly part of that. But I think at the end of the day, where the rubber meets the road in EVs, Tesla, had a great lead. They were the sort of first out, so they have that, sort of pole position. But I think when you step back and say, is everyone else waiting around and ceding, that leadership to them, or are they catching up fast? And I think all of the OEMs, both domestically and globally, are going to be catching up fast. It's going to be exciting. But I think Tesla's biggest concern right now is they didn't have a great deal of competition 2 years ago. They do now.
Art, you've been very generous with your time to help answer a ton of questions for us. But before we let you go, I was hoping you might be willing to answer just a few general investing advice questions for people that are watching. Any tried and true tips that you are carrying into the new year? What have been your standard go-tos with regards to all the conversations we've been covering?
All right, so for 3 things I would say, and I think this is important. So we enter 23 in a much different way than we entered 22. The things we're concerned about in 22 are dissipating. I think the most important thing for individual investors right now, for the first time in nearly a decade, you have the ability to not just look at equities, but fixed income. You're actually getting a return. You haven't been paid in fixed income or that 40% of your 60-40 portfolio in a while. So pay attention to that. And there's some great opportunities out there. The second thing I would say is, when you head into a new investing year, make sure you have a diversified portfolio that is suitable for an economic slowdown. So what does that mean? You want to look at things that you need versus things that you want on one side of a barbell. That includes healthcare, it includes consumer staples, and certainly includes things like healthcare, energy, consumer staples, right? All the things we can't live without. I think they do well in this type of slowing economy. On the other side of that barbell approach, you want to have exposure to growth at a reasonable price. What does that mean? It means incumbent technology companies that have defensible balance sheets, defensible cash flows, leadership, and have proven in all economic cycles that they can handle things. So, things like Microsoft and Alphabet and Apple. So I would say if you're able to get that barbell approach in a diversified portfolio and make sure you keep it rebalanced once a quarter, you're probably going to be able to withstand all the gyrations we see in 2023. And the last thing is, we had a lot of volatility last year. It felt like if that kind of volatility was the kind of thing that kept you awake at night, perhaps your allocation to equities is too high. And for the first time in a long time, you can actually pare that back. So if you're 80% equities and 20% fixed income last year, 60-40 probably a better place for you and help you sleep at night.
All right, final question for you. of the sectors, any most attractive to you right now?
I would tell you right now, energy has pulled back in January, and I think it's going to be the best performing sector in the S&P 500 this year. It'll be the first time a sector has been the best performing sector for 3 consecutive years, going all the way back to the early 90s when that was healthcare. The supply and demand dynamics in an underinvested space lay out in a very positive fashion for this year as well. So I think that any pullbacks in energy is a buying opportunity, and I certainly think it entered last year at about 3% of the S&P 500. It's about 5% now, a little north of 5%. We think it exits this year, closer to 9 or 10%. It was 5% of the S&P 500 and 10% of the S&P 500's earnings. I think energy is probably the number one sector for the third year in a row that has the opportunity to three-peat.
The great Art Hogan, I'm very thankful for your time this morning, my man. We hit through a lot of topics. Oftentimes I have a new guest say, all right, let's just keep it focused. But man, you really had to earn this one. I appreciate you coming by. Art is Managing Director and Chief Market Strategist at B. Riley Financial. Art, thanks, man. Enjoy your day.
All right, JD, and tomorrow at the opening, do not hit that red button again. I think that caused a lot of disruption.
Listen, I was hoping you weren't going to say anything. They don't know that I did. Listen, we still don't know exactly what happened here, but I will do my best to avoid problem for trading at the NYSE tomorrow. Art, thanks a lot. We'll do this again soon.
All right, take care.
All right, folks, and coming up here, we will be bringing you the latest headlines on Amazon as the tech giant launches a subscription prescription service. Got it right that time. Plus, Google facing an antitrust suit. We will give you all the details. And finally, a little bit more to the show. But first, I sat down with financial literacy expert Ross Mack. Ah, yes, the one and only Ross Mack, to discuss his investing do's and don'ts. Take a look. I want to start with investment do's and don'ts. A lot of investors, maybe first-time investors, are watching this interview from the outside saying, I don't even know where to begin. Yeah. What is some early advice you might give to an investor like that, considering getting involved with the game?
Well, one, I would say temper your expectations. I think we go on social media. The vast majority is everybody's getting rich quick, right? I don't know if it's some meme stocks or Reddit or whatever, but I think at the end of the day, be disciplined, be consistent. And I think you want to actually start out by budgeting, because I don't think, the philosophy is, so let me start off with $1,000 and try to make $1 million next year and I'm good to retire, right? The idea is getting rich, but over time, by being consistent and disciplined. So by starting out with the budget, you actually know how much money you could actually invest on a monthly basis. And from there, I'd start off with the most diversified portfolio possible, starting off with index funds. And if you want to get deliver some alpha, right, you could say, which stocks I actually want to single-handedly select. But I think by starting out being diversified, having the right mindset and temper your expectations, I think you'll be good.
How important is, especially for a first-time investor, to do their homework before they even throw any money into the game, right? To make sure that they are dotting their I's, they're crossing their T's, that they could say, I'm making an investment, yes, but I'm doing so from an educated point of view.
I think it's very important, right? I think a pitcher doesn't go out there on the mound without at least warming up, right? What people need to understand is investing is professionals, right? Obviously, we're sitting here trying to, build wealth through investing, and a lot of people are doing it passively. But for the people that are trying to actively invest, trading stock options, trading futures, and, day trading, etc., you got to understand that you're going against true professionals that are controlling trillions of dollars of capital, right? Some of the top institutional security funds. And so what you have to ask yourself is, if I'm going in a game with LeBron and I've never done any homework, he's gonna score 90 points on me, right? Sure. And so I think it's very important to do your homework, because you don't want to get out there and lose your money, and as a result, you find yourself saying, oh, I never want to invest again.
Let's talk crypto specifically, because this has just been a world that's been on fire, and you talk about wild volatility, upswings and downswings as well. And I think that's something that a lot of investors say, I don't want to be on the outside looking in. There's a lot of FOMO that happens in terms of especially the big coins that are trading. Where do you advise people start, even if that's in terms of doing your crypto-specific homework? They're saying, hey, a name like BTC or Ethereum, I want to be involved. I don't even necessarily know where my emphasis should be.
Almost the same way we think about first investing in the stock market, right? How do I get a hold of the best company? So the first thing we say is, let's get the S&P 500. You're going to have 500 of America's best companies. I think you want to have the same concept, right? The same strategy when you're going to crypto. And that is, how do I get the best cryptocurrencies? Obviously, there are thousands of cryptos. I want to say like over 5,000 right now. Might even be more, right? The idea is saying, one, let me understand what I'm investing in. Let me do the homework. The same way, we're not getting on the mound without taking some warm-ups, right? Mm-hmm. But at the same token, you want to say, what does Bitcoin do? What does Ethereum do? And if those are the two best, let me own a little bit of it. Once again, we're scaling in, we're dollar cost averaging, we're buying a little bit on a monthly basis, but also you got to understand what your risk tolerance is. Mm-hmm. if you're 70 years old and you're trying to retire tomorrow, or better yet, if you're 60 years old and you're trying to retire tomorrow, I'm not telling you put 100% of your portfolio on Bitcoin. Absolutely not. It's one of the most volatile assets in the world. Crypto is one of the most volatile asset classes, right? So what you're saying is be truthful with yourself. What is my risk tolerance? What is my what is my investment horizon? And from there, now you're saying, okay, my overall portfolio allocation, maybe I want to put 5 or 10% in crypto, because you have to understand it is very normal for crypto to go down 50%.
And finally, let's talk SpaceX. They're completing a crucial step in making its first orbital launch a reality. Elon Musk's space company conducted what it calls a wet dress rehearsal of its latest Starship prototype to ensure the rocket is ready for launch. Look at that shot. That's a great looking launch pad down there. I guess that's 39B probably down at Kennedy Space Center. The rehearsal includes pretty much every step of a real launch without actually firing the vehicle's engines. According to the company, the test was successful. It marks one of the final milestones the company needed to reach before launch, to infinity and beyond indeed. And folks, that's going to do it for today's edition of The Street Today. A very special thank you to today's guest, Art Hogan, the Managing Director and Chief Market Strategist at B. Riley Financial. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.